Good morning, everybody. This is the first recording of Investing 2020s for the weekend. A little bit of a wrap up, a little bit of a look forward. I made the change because I didn't know that the Thursdays were giving people much of anything that they needed in real time. So I decided I'd like to have a little bit more time to prepare and put something together that was a little bit more in depth. This week, that did not happen because I was in Phoenix, the Grand Canyon, and Las Vegas for a week. I went and saw my future mother-in-law and asked if I could marry her daughter. She said yes. She was very happy. So either she likes me or she's very good at hiding her real feelings. Went and proposed at the Grand Canyon. I had that picture up a couple minutes ago. And then we went to Las Vegas, where I actually made a couple bucks playing craps. Qualified for Diamond Tier with Caesars, which is very exciting. No resort fees next year, and a free trip to the Bahamas. And let's see here. We saw U2 at the Sphere. That was spectacular. I do recommend anybody who wants to see a band that's a favorite of theirs, if you can see them at the Sphere, go and do it. And even if there's not a band that you want to see, they just have like $100 show that you can go and check out the technology, and they do a pretty neat postcards from the world sort of thing, how to see the world. And I'm telling you, it's like being there. The graphics are so good and so immersive that there were points during the U2 concert and beforehand where they were demonstrating the technology, the screen. You know, it's a 360-foot high round screen that reaches behind your peripheral vision everywhere except the fourth deck. So if you're in the second or third deck, you're surrounded. And when they want to make you think that things are moving, you think things are moving. So there was a couple of times where I thought the stage was literally moving, and you cannot adjust quickly to that. It takes several seconds. If you get motion sickness, you should probably take something for that because you'll feel it. At one point before the concert, Jolene goes, "Look, there's a bird in here." And I look up and I'm like, "I don't think that's a bird." And she goes, "Yeah, it's a bird. It's not a bird." So they had made it look like there was an opening in the roof, which there is not, and had a bird fly in. And you could not tell that it wasn't a real bird. So it is pretty amazing. I gotta think that you'll see holographic images incorporated to something like that, or maybe that place at some point. It's just, you know, if you're a Star Trek fan, the holodeck, they are one step away from having the holodeck. That's how neat this thing is. So if you get a chance to go to Vegas and visit the Sphere, even if it's not for a band, go check it out. It's worth your time. What else? I got food poisoning. So I'm on day 5 of food poisoning. This is the first day I don't feel like I want to be curled up in the fetal position. So, you know, I am starting to feel better, so that's good. Lesson of that story is I ordered orange juice while I was playing craps on Tuesday morning, and it was a little bit warm when it got to me. I'm like, okay, no big deal. And I had 2 glasses, and it didn't taste bad, didn't taste great, it was a little bit warm. Well, within 3 hours, I was having a bi-directional explosive biological event. And I'll tell you, moral of the story, add vodka to everything. Why on earth do you drink something in Vegas without vodka? You know, especially
I like your solution.
yeah, I mean, add vodka to everything. All right, so I want to talk about the Fed and what to expect. I know people want to talk about the Middle East. Just like I said, Ukraine would not be a big deal to the markets after a month or two. I'm going to say the same thing about the Middle East. You know, it's going to be rough for a month or two, but unless this breaks out into a full-scale war, and honestly, even if it does, I don't think it matters that much to the markets. The way that this will play out is pretty simple. We will kick the shit out of Iran, and the price of oil will start to go up, and then Saudi Arabia will pump a bunch of oil because we won't kick the shit out of Iran unless they agree to use some of that 3 million barrels a day of excess capacity. Qatar and United Arab Emirates also have excess capacity. So right now, OPEC minus Iran, the excess capacity is over 5 million barrels a day. So there's really not going to be any disruptions that last more than a month. In the meantime, I do reiterate, if you want an American oil play and you're not buying Occidental, I just have no idea what you're thinking. Occidental is already owned like 30 something percent by Berkshire Hathaway. When you consider the warrants, it might be higher already. And they're going to 50%. I think there's a possibility they get to 80%. What would prevent a Berkshire takeover of Occidental is the idea that Berkshire might not want any potential oil company liabilities down the road. So while they may have a 50% investment in Occidental at some point, which is apparently imminent, I don't know what their thoughts are on the potential liabilities of the oil industry with climate change. I do think those lawsuits will continue, and I think that there will be damages awarded. Part of the circular oil and gas economy, where we give the oil and gas industry subsidies for carbon capture, clean up the world, and then we allow the court system to take the money out and hand it to municipalities. It's a convoluted, stupid system, but it's how we do things. And I think Exxon and Chevron are on the hook the most for that. I think Exxon buying Pioneer Resources is largely about having enough leverage in the energy market that they can't be chased down too badly. Chevron just bought Hess, which was an interesting transaction, gave them a 30% ownership stake in the Guyana oil projects off the coast there. The 30% stake is because Exxon owns that. So Chevron has a 30% stake now that previously had been owned by Hess. So now essentially Exxon and Chevron at a 70-30 split are joint partners on the Guyana production, which is probably enough oil to get us to the end of needing a lot of oil. So I don't believe that the Middle East conflict here at this point is going to be as consequential as, say, would have been 5 or 10 years ago, because the Guyana oil is a big deal. We have no problem pumping out the rest of what's in Texas. So I would not expect a lot of problems from the Middle East. Any hiccups should probably be bought. What else? Teresa was good enough, as she always is, to put together the chat magazine for the weekend, some highlights. And there really is a lot going on in the chat. I mean, I once again encourage you. I mean, there is so much going on in here. Les, is just spectacular with putting things together, grabbing charts. He is really embracing the read everything aspect of what I talk about. So, try to visit the chat 2 or 3 times a week, see what's going on there. I talked about what I was buying in real time, and I will publish it this weekend. Among the things that I was buying this week were Ford. So I added to my Ford position on Friday. The sell-off is manic. It's frankly stupid. Right now, there is no value at all assigned to Ford's real estate or their ability to use their fourth industrial revolution technology for joint ventures. I think that them cutting a deal with the UAW, which looks imminent, I guess they're just writing up the formalities at this point, is going to be spectacularly good for them. I don't know what the deal is going to be with the new battery plants. I don't think it matters. As long as they promise to give displaced UAW workers first dibs on new jobs at other plants and the ability to organize once they get there, I think that could be a good compromise. I haven't read if that's the direction they went or if they just agreed for those to be UAW plants to begin with. The one thing I will tell you is that if Ford does joint ventures, I don't see those being UAW plants. And I think that that's probably 99% likely. I'd be very surprised if Ford does joint ventures with, say a healthcare company or whatever, pick your industry. I don't see them making those UAW plants. So I think that Ford is going to grow significantly the next 5 to 10 years by utilizing that real estate that gets freed up as they shift to EVs. Why? Because EVs only take half of the floor space, and they're adding some mega plants. So you're going to see 70 to 80% of the Ford industrial real estate freed up for other uses or for sale. So Ford is in a great place right there. And honestly, with UAW workers making between $60,000 and $100,000 a year, that is not something that's going to hurt them. The raises barely beat inflation, and hopefully they got some extra retirement benefits and job security, because the world's changing, and I don't believe it's going to slow down anytime soon. What else? We talked about Bitcoin. I was pounding on that last November to buy Bitcoin. And every time it dipped, I mentioned it. I've mentioned it, 7, 8 times. I told you 3 or 4 times in the last couple of months, buy Bitcoin. And here it is, starting to break out. When it gets above this line here, there's a pretty good chance that it runs not only through this area, but I think sets new all-time highs. Oh, I don't know, not in a straight line necessarily, but in the next 2 or 3 years. I really think that Bitcoin is over 100,000 by 5 years at a maximum. It's to 100,000. And I think that it's probably, I don't know, sooner than that. I just can't see Bitcoin not being 6 figures in 5 years. We talked about whether it's time to buy end phase. Teresa's been watching this one come down. This is a chart that she did a couple years ago. I said the easy money was made. It shot straight up like days later, and I was called stupid. Well, here we are as the price approaches 70, and I think that what I said, that the easy money was made through 70, now is becoming pretty apparent, right? This is probably support unless it's not. So I think you can see end phase get back into the 70s pretty easily, at which point maybe we start to take a look at it. However, I really like the idea of using TAN to just get a whole spread of the solar companies. With the whole solar industry bottoming out, I don't know that we're going to need to take single stock risk. We can measure the beta to see which companies are likely to advance the most, but the top 10 holdings in TAN are, the best companies for the most part and take up 60 or 70% of that index. So you can get a basket of, say, 10 or 12 really good solar stocks, avoid single stock risk, capture almost all the upside, even of the best stocks. And I think you'll do very well. So I'm probably not going to buy individual large cap solar stocks. I'm probably just going to trade the industry because I think that has been the easiest thing to do with the least amount of risk, margin of safety. So the most important thing here is Jerome Powell. So we'll kind of shift into that. If Jerome Powell, and I've just been using mean and nice to describe him, if Jerome Powell is mean and he talks about higher for longer, and especially if he mentions the potential to raise interest rates again, I think that they get another 3, 4, 5 weeks of a pretty rough stock market. I don't know how he feels about the stock market at this point. He has largely gotten his corrections. Small caps are destroyed. Mid caps are beat up. They started to rally and they've just gotten beat up again lately. Take a look at Square and Unity and some of our other mid cap, what we consider mid cap investments. They have not done well. So if he feels like it's time to let up, I don't think he'll outright talk about potential interest rate cuts. I think what he will talk about is the idea that barring anything extraordinary, he's probably done raising rates. If he can get that out of his mouth, that he's done raising rates barring anything extraordinary, I think the market starts to settle out and rise within, hours or days pretty quick. I think that the addition of liquidity ultimately is what is required to really give stocks legs. And I don't see that happening, though, until next year. So way back in November of 2021, 2 years ago, seems like so long ago, told you the Fed warned you. Are you going to fight the Fed? Certain other pundits out there talking about the Fed doesn't matter. Just the most intellectually lazy thing I've ever heard. Absolutely, the Fed matters. Liquidity drives everything. As liquidity dries up, traders gain more power using leverage because there's nobody to fight back. And that's particularly effective when shorting, which is why a lot of short positions have just kicked ass lately. There is the likelihood that we are going to see a short squeeze because there was a very interesting court ruling a couple of months ago, which basically said brokerages are liable for the damages suffered by stocks that are naked shorted. So naked shorts are real. That's where failure to deliver comes from. They are shorting with shares that they never borrowed, and the brokerages were found by a court to be complicit in that they were indeed required to make sure that naked shorting did not occur. I don't know if that's in the appeals process somewhere, but I would imagine that the SEC, which is also on this train, is going to make naked shorting incredibly difficult imminently. And I believe that the brokerages at some point are going to have to just start agreeing not to fight this. The brokerages have allowed naked shorting. They look the other way because they're making money. And I think it's about to stop. Sometime next year, it's going to be over with. And that'll be good. If it doesn't end, then we'll see how big the short squeezes get. But the addition of liquidity by the Fed is what is going to drive things. Remember, I told you that the Fed was reloading its bazooka again almost 2 years ago. The bazooka is almost reloaded because it's the QT. So the quantitative tightening has drained liquidity from the markets. It has shrunk the Fed balance sheet a bit, except in the spring when they did quantitative easing to bail out a couple of banks and to shore up some bank balance sheets. Essentially, they did quantitative tightening and quantitative easing at the same time so that the balance sheet moved sideways. It went down, went up, went down, and ended up in the same place. I think next year you're going to see the same thing. I think you will see quantitative tightening be the official policy. But as the banks run into problems with commercial real estate, the Federal Reserve will offer them money in return for something. Because remember, it's the big banks that own the Fed, not the mid-sized regional banks. So while the Fed told the regional banks to start looking at mergers last spring, that really has not materialized yet. As these banks look for help because of the commercial loan crisis that's unfolding, and it is a crisis. I mean, these banks are looking at 30 to 50 cents on the dollar for what they loaned out. And they're getting the keys back to all sorts of buildings that they have to manage and then flip. And it takes a year or two in every case. Private equity is trying to get in there. Of course, they're offering 30 cents on a dollar, not 50. And the banks try to fight back. But ultimately, they're going to need money through the Fed to make sure their balance sheets don't get blown up. And I think the Fed is going to tell them, well, we'll give you money. However, you're going to merge with somebody. Figure it out. Get bigger. And I think that is going to be the company line at the Fed next year, is that they force regional bank mergers because they want banks with bigger balance sheets so that they don't have to piecemeal fix things, and so they can create a system that's more insured and, most importantly, a system that can support the treasury market. Right now, the $25 trillion treasury market has seen a huge uptick in hedge funds participation, providing liquidity, as Ken Griffin, the profiteer-in-chief at Citadel, would call it. The reality is that the banks haven't been strong enough to support the treasury market because of a combination of things. First off, there's so many banks. We are the most overbanked nation in the world, that the talent level of the CFOs and the CEOs is not as excellent as you'd want it to be. And they have made bad loans in the name of immediate profits, and they have managed their balance sheets for shit. You have fully 1/3 of the banks out there, small and mid-size in particular, regionals, that are upside down on their balance sheets if they really had to mark everything to market. Now, there's a need for the federal government to make most of their loans to domestic borrowers. The best domestic borrowers are the banks. I will show you some charts in the article that I'll put together this weekend that show how that market has moved over the years. The Fed wants to bring the banks back into the treasury market. That means they need more big banks. It'll be very easy to see the number of regional banks cut in half or even by 2/3 and create another batch of 10 or 12 or 15 national or super regional banks that have the types of balance sheets that can be used to prop up the treasury market for the next decade or so. And I say for the next decade or so because once the boomers are all retired and we get through that little crisis at the end of the decade, sometime in the 2030s, if you're understanding what's going on with the economy right now, what you're starting to realize is that, oh my gosh, the economy is strong. U.S. GDP growth massively outperformed with 4.9%. I've been telling you for a few years that the United States economy was the strongest in the world, and all this doom and gloom was bullshit. As long as Jay Powell doesn't ruin employment, which would be the height of stupidity, right? As long as he doesn't cause stagflation, that guy, as long as he doesn't cause stagflation, we're in good shape. That is the worst thing he could do, which is why I don't think he's going to tighten anymore. I know that he has people telling him this. I know Austin Goolsbee is from the left. I don't really know anybody who's telling him to tighten anymore. Most of those people have retired. So he should be getting good information. Sometime in the 2030s, because we're going to continue to be tight on immigration, we'll let enough people in to take care of us, but it's never going to be the number that want to come here. And we're going to have slow growth forever, managed growth, try to keep supply and demand in line, gently rising on the demand. And at some point, energy gets so cheap and healthcare switches from inflation to deflation because of AI, and the boomers start to die, and the millennials completely take over the economy, we are going to get a period where revenues in the federal budget exceed expenditures sometime in the 2030s. There's a very good possibility that in the next 2 years, you see the federal budget essentially flat, only minor increases, only 1 or 2% above GDP, which is really what the target is. If the inflation target's 2%, then you can spend 2% more than what you pull in tax revenue. That then in the long run does not add to the deficit or the debt, I should say. So I think that we are in a spot that people don't understand. When people don't understand things, you get uncertainty and they wait to be led. The Fed is what is going to lead. I believe they're going to do it right. I just don't know when they signal that they get it, because when Mohammed El-Arian comes out and says, I don't think that the Fed has any vision, I think that he is overstating to get on TV, which he clearly loves. I think the Fed does have vision. And as I've told you before, calling them stupid is stupid. I think that they just provide you with selective information. They lie, for lack of a better word. I think the Fed has always known what they wanted. They're just waiting it out for the moment when they can say, hey, look over there, squirrel. So whether Jay Powell backs off a little bit next week or December or in January, I don't know which month, but it's coming. You should be accumulating stocks during that time frame slowly. And if we get a fall off the cliff moment in the next month or so, which I think is possible, especially if Jay Powell stays mean, then maybe that is the bottom point. Maybe that's the spot where you go 99% in. So with that, hey, Shooter, would you like to share your screen?
Sure. You see me?
I can see you now. All right. So what I asked Shooter to do is give us a couple of scenarios, basically nice Jay Powell versus mean Jay Powell. So what can happen if Jay Powell is mean and the market decides to sell off? And what can happen if Jay Powell is nice and the market starts to be more constructive? So, Shooter, what do we think?
Well, current count suggests that we're going to come in around 404, but I believe it bleeds just because of how so many of the internal stocks are acting. So I think our trend support line here, around that 400 level is pretty much given. And we really don't have much support down until that 342 from there. I mean, so once that trend support breaks, we potentially could have a flush there. But, this is that wedge that we talked about. Hold on a second, I gotta move my floating screen. But we had spoke about that, I don't know, maybe about 3 months ago, I think.
Well, we've been talking about it on and off for 2 years.
Yeah. So, this is what the flat is looking like here. So that puts us down to about 390 on the count. If we put that out to a 9 wave, we're just going to be here forever if that holds. So, to a certain extent, even though it's going to be a little more volatile, we want it to flush down to support, down to that 342. So we don't have to deal with this for an extended period of time, because then once that's done and over, we'll start building that base and market will build back up. And we actually might get back above 475, 500 in the next 6 months following that kind of a flush.
So what does it take to see this breakdown to support?
Well, as far as a complete breakdown, it would basically morph into an ABC pattern. Let me get it up here a second. Mouse stuck. So that would take us down to about 295.93 if that morphs into an ABC.
Oh,
this decent flush. There's not really many alternatives here. Either we're going to get the wedge and it's a 5 wave, or we're going to get the wedge and it's a 9 wave, or we break out from here and it doesn't become the 5 wave or the 9 wave, or we get the ABC down. Now, the problem with the ABC down, I think once we get past that 300 level, and I have to go out a little bit further in time, our support line is way the heck down here for anything below there. So, once that, if that breaches, we're going to be testing our 2008 lows. I mean, pretty aggressively. Really is 78.6 breaks below that 274. We're going to come back down and really test our 2 or our 4 down here in this range of 150 to 200. So I'd rather just see a flush right to support and then stop there.
All right. So the level that I've been talking about is basically where that support is. I've said that the January 2020 price levels were probably going to be seen again. And my rationale for that was the end of a QE period. So I don't know that anything before the 2016 bottom, that right where that 5 is.
Well, our wave 2,
your big 4. So I don't subscribe to that wave theory. Okay, I don't. I think that your 1, 2,
it all depends on whether that support holds. I mean, that's the thing. Once that support's broken, then you typically have follow through. So just looking at the pattern over time, and this is our cycle wave 1, cycle wave 2. All right. This is our cycle wave 3, cycle wave 4, and this is cycle wave 5. All right. So now we have to step up in our time frames and look at the super cycles. Now, there's nothing that prohibits a wave 1 from going down to 50% to 200. I mean, there's no technical reason that could not happen. So I think we really need to watch this. One thing I had a big problem with this flush in 2020 was simply that it was so far out of the norm as far as our trend support was. And I'm just going to pull in another trend support line. We come in from our 2 and we look at this right here. That really is our line in the sand, not so much this breakdown. I mean, we could come down and say it's here, but that was such an outlier event. At this point, I'm excluding it from my view. So then what happens? So if we get a retrace, and let's just pull in a quick fib level. I'm working with a new monitor, so I'm struggling a little bit. So looking at trend support, if we break down from trend support, and just assume our trend support, that would put us, we could go down to 180, 206, and it still would be in the range. Realize the market trades 78.6. So even though most of my targets are the 50% back, the market is always looking at the 78.6.
All right. So I will just say I don't subscribe to the super cycles. I think theoretically, I just think the whole thing is flawed because of the changes in the amount of money and debt in the world. So here's what I'd like you to do. Erase all that. Start over. Go back to 2016 where your 4 was and make that the start of a new cycle. So right there, that bottom, that C4, start everything brand new right there. Get rid of everything else on the screen. Just start over. All right. Make that the start of history in 2016, excuse me. I don't think that people fully understand quantitative significance of all the quantitative easing. What we have experienced even since 2008, but more importantly, that consolidation from 2014 to 2016. Takes a while to erase it all, huh?
Using that 180-102 as our starting point,
use that.
It says that 348.11 was our 2.
Yeah.
So, basically, as long as we stay above that 348.11, if that's the wave that we're going to get, we'll be looking at 647 by 2028.
I think that something along this line is likely. I do think that we're going to see the support hit. I think that the double bottom here is
viable. I agree.
Yeah, I think it's very viable, which means that it's kind of breaking a line, but that happens all the time. Take a look. And ultimately, the reason I believe that that's very viable is because in a world that's so manipulated by the monetary system and the perpetual fight between the last standing bond vigilantes, there is a struggle between those who want to burn it all down, your jokers of the world, who just want to get rich and they don't care what they destroy, and your central banks and your governments and the geopolitical associations, competitions, and alliances that come and go. That 2014 to 16 period, if you take a look at the period from post-COVID, where it first hits the support, right? It was resistance. No, here. Can you see my mouse?
No, I don't have dual screen up. Sorry.
So go up to 358.75.
Okay.
That area right there, and then up and then down, then up and down. There's your double bottom. It is not dissimilar to the 2014 to 16 range, other than scale. So it is the same sort of churn, basically allowing the market to consolidate.
Yeah, it's actually very similar to January 2018. This flag, it's more of a flag there.
Yeah.
We pushed a little bit and then came down, except for we're getting a broader pattern, which happens in the count. They extend broader over time. So, just like when we get a high up in 2025, the lows we will see will be just as broad as we're seeing here, but broader.
So from a theoretical standpoint, the addition of all that capital into the system, unless we have a vaporization event like we had in 2007, 8, 9, the odds of breaking down to new lows, right, to approaching 2008 and 9 prices are virtually zero. And even if there was a vaporization event, the odds of breaking down below the 2018 and 2020 lows are almost impossible. Now, there is one megaphone pattern that you could draw there if you wanted to. You could draw a megaphone connecting the 2018 and 2020 lows. The problem with that megaphone is that you had the 2018 lows. The problem with that megaphone is that there is so much monetary distortion during that period that I don't think is valid, right? Because I've talked about that megaphone before. So from the bottom of 2018 to the bottom of 2020, you can draw a line, and it shows you where the downside risk is. And it aims almost at your 78.6 line. So can you do that?
Yeah, if you draw the megaphone using this.
Yeah. So, there's a possibility that could happen. We could see a price under 200 on SPY. It would take...
And the line in the sand's right here.
But it would take two things for us to break down really below resistance.
This is our historic trend line, and it's pretty much held.
Yeah.
Drive 1, drive 2, drive 3, drive 4. This was really drive 5. So then we get a 6, a 7, and an 8. Okay, overshoots are not impossible, but the likelihood's really low. I would say less than 3%.
Right.
But if that trend support breaks, it will flush below this low. I'm like 90% confident that
it would go right towards your 78.6 line.
Yeah, and bounce. And then we get our back test, and then we would find out if we get a bottom there or we continue to back test down lower there. So it would go to like the 156 then. Right. It's going to accelerate as those legs break to the downside. And we're seeing one thing we're seeing now in the fangs is they really are pulling us down in many ways. And they were really they were the generals, that were pushing us. And they're just rolling over. Too easy in my view, just way too easy. Too many people are giving up on them, which indicates there's more sellers than buyers. So I think the confidence in the fangs, and we're even seeing that in Tesla, is a huge example of how that fear of loss comes in, where all of a sudden everybody isn't worried about their gains. They're protecting their cash and they're getting out of the way. And that just keeps growing. We're seeing that now. So that's concerning, even though even the internals are a little more bullish, not much, 3 to 5% more bullish. And I think we need a flush. We need a decent 3 to 5% drawdown to clear it out. Then we got a shot of regaining the highs. That's what I think would be the perfect scenario.
So the reason I talk about a vaporization event is because there's a possibility next year that it happens with the commercial banks, with the regional banks having the commercial loan problem. So I don't want to say that it's impossible that we break down below 350-ish. Clearly possible.
I'd say we got a 50% shot at 350 right now.
Yeah.
And a 10% shot below that. That's at least, now we break below this low, that 358 to 342 band, resistance band. Right. We break below there, then I would say there's a 50% shot that we get below 350. I would increase those odds significantly there.
Right. Well, and so I think the thing we have to watch is, does the Federal Reserve make a mistake with regard to the regional banks? If the regional banks go to shit, I think that you see stagflation, and I think you see a massive shock. I think that that's going to happen, but I think that that's the thing that we have to.
So what would cause the regional banks to go to shit? What do you think?
the wall of commercial debt that they're facing is massive.
Yeah.
It's
Would $14 trillion collapse it?
well, we'll see what they actually get, right? They're going to take haircuts on a lot of their commercial real estate, and everything is fractional. So there is $2 to $3 trillion out there that is at risk. Now, that's not a lot of money, weirdly, because the Federal Reserve can create that in a second. The question is, how does the cat and mouse game on mergers play out? It is clear, and the Fed said it 6 months ago, that they want to see mergers and bigger banks so that they can create a system that's big enough to support the treasury market without the help of the Chinese. That is the thing to look for. Now, I don't know how much pressure it's going to take for that to happen. Are the regional bank executives in their quest for power and money going to push back on the Fed? And if they do, what does the Fed do about it? If the Fed tells them to zuck off, merge, or go under, we have quite the standoff. And that could cause a lot of 2008-like stuff. And if we get 2008-like stuff, then that SPY around 200 is viable. I don't think that's going to happen, but anybody who puts it out of the range of possibility, I think isn't taking into consideration the full range of things it could have.
Yeah.
Right?
Well, that's one reason I'm suggesting hedging, because really they're relatively cheap. If you go out just a little bit in time, the 390, the January 390 and 400 puts on the SPY will pay really well once we, and they already have, because we started suggesting that we go there, right here on this high. So we started suggesting that right around 438. So, they're well into the money at this point. And, if we go lower, I'm just going to roll further out and do 380, 385s and just continuing to roll those hedges. So those hedges can really shelter you really well with a small percentage of your portfolio there, as well as selling covered calls on your primary holding, especially the FANGs. I like some of those as well still. But it's, I think the challenging part is we're probably already, I think across the board, most people are down between 15 and 30% on their portfolios. And so we, if we have significant downside from here, another 20 or 30% down is a lot of heat. So that really has sort of been my focus, is to try and figure out how to mitigate that in some way, which doesn't put too much risk on the table and is directional according to the counts that I can see. So, I was targeting 400 first, actually 420s, 400, and then I added 390s coming into this week, just because the counts were bleeding enough with the internals where I had a 70% likelihood in my mind that it would manifest. So I was thinking it would be a low risk hedge kind of thing. But is there anything else that's on your mind that might work for trying to hedge some portfolios to the downside?
I think a couple of things. First of all, shameless plug. So those are the types of hedges that Shooter and the other traders over at Fundamental Trends Rare talk about in their chat room. So those are hedging ideas which are more advanced, which require, it's not something that you can just say, I'm going to copy that. I mean, I think you have to have some education, but at Fundamental Trends Rare, that's the sort of thing that Shooter's been doing to help protect people. Now, what I've been doing is I obviously, for most of my career, have kept 20 to 40% of my money in cash and sold cash secured puts against it. Well, because I bill my fees every quarter, so I get to take a look at where I am on the year. Depending on the account, I'm up or down single digits for the year, and that's with a very large small and mid cap allocation that I've been scaling into for a year and a half. I have sold so many cash secured puts that have expired that, I'm hanging around even plus or minus single digits for the year.
You ever feel guilty for doing that?
No, I do not feel guilty for doing that. And I just want to encourage people to get over the idea about options that some idiot broker or financial advisor from Edward Jones or Ameriprise or some other shit institution gave you. Options are tools. You wouldn't take a look in your toolbox and say, that's fucking evil screwdriver, right? An evil hammer because of what they could do. But they're tools that you can use to generate income and mitigate risk. You don't have to take the speculative side of the trade. And the easiest trade is to sell puts on something that you want anyway, collect the premium, and somewhere between half and 3/4 of the time, it's just going to expire, and you'll have made 6, 7, 8, 9, 10% on your cash over 2 or 3 months. Well, think about that. If you can make even 5% on your cash every quarter, that's 20% a year. And that's what I've been doing on 20 to 40% of my cash for 2 decades. So it's a pretty good way to do things because you only get stocks put to you tomorrow that are cheaper than what you would have paid today. And the default is that you're collecting an annualized right around, I mean, pretty consistently in my career, been right around 20%, sometimes 15, sometimes 30, but right around 20% annualized per year for selling puts against your cash. Tell me that you wouldn't take 20% on your money market money and then every now and then buy a stock that you like for cheaper than you could have got it today. I mean, it's a no-brainer, and it works, and it's easy to do, and it's cyclical, and it's systematic. You don't have to watch the market every day. You make a few hours of changes every week. Literally, you just read your paper, read your articles, and then you go in and you tweak your accounts twice a week for an hour. I mean, that's all you need to do. And if you do that, you're going to have such better results. I don't know what else I can say. So other than on Mondays, I'm going to really work on teaching people how to use options to cut risk, generate income, and have a easy to use process that keeps you 60 to 80% in the stock market. You know, if you're younger, you'll be over 80%, but 60 to 80% in the stock market all the time. Warren Buffett says you should be 100% in the stock market, but at the same time, he sells all kinds of puts. I don't know that everybody always knows that. I mean, it comes up in the news every time he does it, but Berkshire Hathaway is famous for selling puts, right? So they have a certain amount of cash. They don't want to get nothing on it or the treasury rate. You know, people say, oh, I get 5% in treasuries. And I'm telling you, you get 5% every quarter. So learn how to sell options because selling options is a great tool for generating income. Now, some of the hedges the shooter uses are actually buying options, buying puts on the S&P 500. And it's rare that you want to do that. And you only do it with a small position because you should use it as protection, not speculation. Once you start to speculate, you're very highly at risk. But if you just use it as a way of protecting your portfolio from a big decline, it's cheap insurance. It's like having term life, right? It's cheap insurance. If you happen to die, you get paid off. Granted, you're dead, but, you know, same kind of concept. So I guess what I want to close with is this. The whole double bottom scenario, I think, is in play. I think we could be there by December, and then the Fed could change its mind. Now, if this week Jay Powell is nicer than I expect, then I don't think we get all the way down here. I think we get to around 400, and then we bounce. And there's some pretty impressive people who think that that's what's going to happen. My problem with that is I think there's some jigging around going to have to happen with the banks next year. So even if we do get a bounce here soon, I think we still revisit and potentially end up in that 9 wave. So we'll
that
see.
Actually measures really well at 398.99. Should give us a bounce to maybe 436 once we get down there, just above the second trend support line.
It's almost like I read your charts. I leave you alone in that chat room, man, but I read what you're doing. So, you know, I'm not a micromanager. I watch and I learn, and I have my own thoughts about Elliott Wave. You know, I've been studying it for 20 years, and
yeah, I got a lot of birds in my ear, man. I listen to some really smart folks.
Yeah. And
you know, I mean, it's where, you know, I've spent the last 5 years. I mean, I guarantee there's less than 1% of the people who read or listen to as much stuff as I do. I'm like, I'm a nut job when it comes down to it. I just love doing it. So
yeah, between the two piles of stuff that we both listen to, and read, it's a lot of stuff. You know, my biggest beef with Elliott Wave is that I don't think there's a functional way for it to account for all the quantitative changes in the monetary system. But
it complains. One thing I like about it is it gives you, you know, you have to watch it on certain time frames, but it's sort of like a kid who starts to whine. Well, when everybody's agreeing, you know, and we're pumping, you know, you got no noise whatsoever. when everybody's scared to death and we're flushing, there's no noise. But when you're in the middle, it's like walking into a daycare with 300 kids in it, all screaming.
Right. Well, that intermediate term time frame, right? The current cycle, if you can identify where the cycle started, which is why I point to 2014 to 16, that flat period. If you can figure out where your cycle started and ignore the super historical long-term stuff, which I just think doesn't matter that much.
Well, here's your trough, here's your peak, and here's your trough. So that's your last cycle that we've had. So we're in another one, or this is an ABC and we're not done yet. And we're going to test the floor.
Right. Well, and if you connected the bottom of 2016, the bottom of 2018, and the bottom in 2020, it's a freaking line, and it points right at that 78.6.
Yep.
So that's the bottom of the megaphone. So if the bottom of 2018 to the bottom of 2020, my fault there. So there's your megaphone, and the reason why that's important is because there's, I think, legitimate questions about where things would have gone with COVID had we not done so much QE, right? And so you can actually stretch that line in 2018 up to the early part of 2018. And that early part of 2018 is the volatility event. So the more proper way to do that is take the bottom in 2018 and actually make the bottom, right there, the volatility event, because those connect the cycle. So what if, right? So you take a look at this and you start drawing these lines in and you say, yeah, I guess it's possible, but you have to start saying, but what's probable? And the idea that we would vaporize the world financially is just so improbable that you can't.
It's still an overshoot, though. I mean, technically, it's in line looking at that. I mean, drive 1, drive 2, drive 3 is an overshoot.
The idea that we would break the 2020 lows, basically that 78.6 line, completely relies on some sort of catastrophic financial event. And the only one that we see out there right now is the potential for the American banks to go to shit. And I guess the secondary one that people point to is the Chinese banks to go to shit. But I don't think in either case it's likely. It's just not likely. Remember, China is on net a debt-free country, because they have foreign reserves and they have internal debts, and they can just swap them, right, one pocket to the other. So China's in a position where they're not really all that at risk. People want to say they're at super risk. I mean, all these people who have been talking about the end of the world have been wrong for a really long time. And it's probably just not going to happen. And if it does, so what? We
don't need to worry about it anyways.
That's right. So, we want to deal in probabilities, and the probabilities are that we don't get a breakdown below about the middle 300s on the S&P. Do you keep a little bit of cash for something that bad? I guess. But I think the wiser thing is to get really fully invested. And if you're scared as hell, then buy some out of the money puts and have some cheap insurance.
Well, let's use Ford as an example. The $10 March puts will pay you 8.5% for 6 months. If you bought you sold the $10 puts and we dropped to $8 and you sold another tranche of $8 puts and they got put to you, your average price is $9 a share, but you've already made $1.75. So you're in the money by about $1.30.
Right. And that's why selling puts, I think, just continuously eliminates the need to speculate on horrible things, allows you to stay fully invested over time. And as we know, being fully invested over time has been the winning strategy forever. So even if you're 60% stocks and writing puts against your cash, that will typically help you win forever. It is how I made my money the last 20 years. And I have never seen anything as good as being a put seller. I've never seen anything as good, because all the people who speculate are going to overpay you for those puts all the time. You are getting overpaid for those puts, given that stocks generally go up all the time. That is why so many of them expire. Speculators overpay because they let their emotions force them to overpay. Take the money. All right, let's call it a day. I'm going to edit this up, get it published. I'm going to run some errands if I can stay out of the fetal position. I am feeling like The worst of the food poisoning is by me. I still have a couple rocks in my gut, but I can stand upright, so that's good. All right, thanks, Shooter.
Be well, my friend.
Yeah, thanks everybody. We'll talk soon.
Until next time, folks. Thanks for joining us.